All right. Well, thank you so much for being here. I really, really appreciate your interest. And hopefully, we can give you a ton of good information today. So, we're going to go ahead and just jump right into it. Our objectives today are to give you a bunch of really specific and valuable tools and tips and strategies that you can use to buy a home in California. And this stuff will apply all across California, not just in San Diego. So we'll send you a recording at the end of the webinar, and you can feel free to share it with anybody else in California who might be interested in this information. Very importantly, we want to spare you the financial and emotional distress of hiring the wrong agent, because there are obviously so many real estate agents in the state of California, and unfortunately, a lot of them don't know, they know more about how to get you to sign up as a client rather than how to really fully serve you and protect your best interest throughout the transaction. So we want to give you some insight on how to evaluate the different potential agents you might be hiring and make sure that they really know their stuff. And of course, I would love to be an ongoing source of information to anyone who would like to reach out to me. Feel free to email me or call me anytime, and I'm going to get you my contact info in a second. So another good way to keep in touch with me and to keep up to date on real estate and financing issues and other fun stuff like architecture and design and San Diego events and things like that is by liking our Facebook page. So when you go to claim your free gift at the end of the webinar, there'll be a link there where you can go to our Facebook page and make sure that you like our Facebook page. Okay, and we'll be ending with some live Q&A. So just a little bit about me. I'm Lauren Empey. I'm an attorney and a real estate broker and owner of Empey Realty. We're located in Pacific Beach in San Diego. And a little bit of my background, the attorney background, I feel like has given me a huge leg up in the real estate field because it's that training and mental discipline to be really detail oriented and to be always thinking 3 steps ahead in terms of strategy that's allowed me to really serve my real estate clients and like go beyond the basics, to be really thinking 3 steps ahead and negotiating those initial contract terms so that once you get into escrow, you're not going to have as many unwanted surprises as you could potentially have. There's always something in a real estate transaction. There's always some sort of unexpected thing, but the more you can anticipate and make sure that these little tiny contract terms are in your favor, the better off you're going to be when those little unwanted surprises pop up. So let's see here. I'll write down my contact information real quick in case you ever want to get in touch with me, or if you have to leave the broadcast early, you can always get back with me and I can send you that free gift, which is I'm calling it the real estate cheat sheet. Basically, it's a condensed version of everything that we're going to be talking about in this webinar. Okay, so here's a quick overview of what we're going to go over. Don't worry if this feels like information overload, because honestly, it is a lot of stuff to cover. So, I mean, it'll necessarily be a bit of an overview. And if you have any specific questions that we don't have answered, please do ask me in the Q&A at the end or reach out to me after the webinar. All right, so let's just move on here. So we have fundamentals. We're going to talk about some financing and how that works, principles for real estate negotiation, how the sale process works in California, and then different strategies for buying a home, strategies for if you want to sell one home and buy a new home, and interview questions to ask before you hire a buyer's agent. So just so we don't lose anyone from the start, the MLS stands for Multiple Listing Service. These are regional organizations that compile data about homes that are for sale. And so for instance, the San Diego MLS is called Sandicor. The Bay Area MLS is called MLS Listings. So, it's sort of just a semantic thing, but just think about the fact that these are little modules of these conglomerations of information. Only real estate agents are allowed to participate and put things into the MLS or to get that information directly from the MLS because they want to make sure that it's accurate, but they also want to protect the sellers. So, for instance, there will be showing instructions, and you don't want to for instance, if your house is vacant, the seller probably doesn't want that distributed all over the internet that, hey, this house is vacant. So, real estate licensees have duties to protect their clients and protect this information. So that's why it's only available to people with a license. So, okay, bottom line, Zillow, Trulia, Realtor.com, even my own website that's, open to the public, all of these websites where you can get listing data, get their information through a syndication process from the local MLS organizations. So for instance, Zillow just gets the information from like all the different MLSs. But this syndication process takes a couple days, usually 3 days, sometimes more, like a couple weeks, to get the updated information. So bottom line, Zillow is a great place to start and get an idea of what the market's doing, but it's not going to get you across the finish line. The only way to get accurate, up-to-date information about properties for sale is a direct connection to the MLS. And I can offer that to you, and I'm going to offer that to you at the end of our session here, a connection to the San Diego MLS, which I'm a member of. And now real quickly, this is very, very important. When you hire a real estate agent, they become your fiduciary. So I want to make sure that you as a potential client understand what this means, and you want to make sure that any agent you're interviewing understands what this means, because the fiduciary duty is basically the highest legal duty that one person can have to another person. So the legal definition is a person having duties involving good faith, trust, special confidence, and candor to another. This is the same that a duty that a trustee has to the beneficiaries of a trust. A fiduciary always has to put the best interests of that other person above and beyond their own interests, and to treat them with complete honesty and candor. So this duty of loyalty includes disclosing all material facts, disclosing and avoiding all conflicts of interest, and having no self-dealing. Your interest as the buyer is the only thing that should be factoring into these decisions. So you want to make sure your agent understands that, and from the very beginning that they're going to be honest with you about the different issues you want to ask them, especially compensation. And then a real quick overview on financing, because this could be a whole webinar in and of itself. Bottom line, you do want to connect with a trustworthy lender who can break down all your specific options, because it's so dependent on your particular situation. But just as a brief overview, you not only need to think about your down payment when you're ready to buy a home, but also the closing costs. And they're generally about 2% of the purchase price on top of your down payment. Those closing costs are things like prepaid property insurance. Depending on where you are in the property insurance billing cycle, you'll have to prepay some of that. Homeowners insurance. You're going to have the cost for a home inspection when you get into escrow and you start doing your investigations into the home. You're going to have the costs that go along with funding the loan, which is like the appraisal and different things like that. You're going to have escrow fees, title fees. All of these things are lumped together to be your closing costs, and they're generally around 2% that you want to plan for. And now sometimes you can ask the seller to pay for your closing costs as a credit. They give you a credit on the escrow worksheet. So sometimes you can get away with it. It's not that uncommon, actually, to make an offer and have the seller pay for your closing costs. So under different loan options, you can pay as your down payment as little as 3%. Under the new rules, conventional loans just changed their rules, and they're accepting down payments as low as 3% now. FHA has been traditionally the model for doing a lower down payment. They allow a 3.5% down payment, and you are going to be paying a mortgage insurance premium every month when you do an FHA or a conventional loan with a less than 20% down payment. If you don't want to pay mortgage insurance, it's going to be a couple $100s every month in addition to your normal payment. Then you need to make sure you're getting at least 20% down payment. And then the VA loan program is really great for anybody who is in the military or has a background in the military, and they can qualify for these special loans with a 0% down payment. And there's some really good perks for that. So if you know anyone who's in the military, I'm going to give you a great lender's contact information during this little webinar, so you can send that along to them if they're interested. So just keep in mind that even when you get pre-approved for a loan, 25% of those pre-approvals don't actually get final approval once it gets to the underwriter. So you want to make sure you're working with a really good loan originator or, sorry, I just forget the term, but a really good loan officer who understands all the nuances of different people's particular financial situations. They can anticipate any challenges that you might face when you get to the underwriter's final approval stage, and they can advocate on your behalf to make sure that the underwriter understands any exceptions they're asking them to make. I talked to Kim Carlson, is the lender I'm going to recommend to you guys today. And when I was asking her if this was an accurate figure, she confirmed that it was, but she said, not with the clients that she pre-qualifies, because obviously she knows what she's talking about. But just know that you don't want to find, somebody on the internet or some company that you see on a TV commercial. You really want to make a connection with somebody who really knows their stuff. They're local, they're in California. There are some California specific things that the lender will need to know, and that could be a problem later. So we'll move on from this. Oh, and this is actually really exciting. Mortgage rates just hit another all-time low, the lowest they've been since 2013. And actually, that was the lowest they've been since the early 80s. So they're actually back down below 4%. This was kind of unexpected. All the analysts are saying for sure loan interest rates are going to go up this year, because there are a number of factors that influence where rates are. But one of them is that the Federal Reserve has been keeping rates artificially low by buying up millions of dollars per month in mortgage and treasury bonds. And the Federal Reserve has been very vocal and active in reducing the amount of money they're putting into these bonds every month. So as they stop keeping things artificially low by putting money into these bonds, we're expecting rates to go up. The fact that they just went down again last month or within the last few weeks, it was a combination of factors about the unemployment numbers coming out. The numbers were positive. They were very favorable. So that increased confidence in lending. And also there's some turmoil going on in the global economy where it's causing foreign investors to put more of their money into the US dollar, which makes more money available for lending. So a combination of all these factors has made it a very favorable climate for borrowing right now. Also, the FHA loan program lowered its mortgage insurance premiums by 0.5%. So that, in combination with the economic factors that made the rates go back down, right now is an amazing time if you're thinking about buying to go ahead and see if you can pull that off. Now, we do still think that the rates are going to go up this year. Most of the forecasts think that rates are going to go up at least 1% by the end of the year. But the Fed said basically they're not going to take any action until April. So you have a little bit of time. And even then, the Fed, has indicated that they're going to take a slow and steady approach. So they're not going to do anything drastic, but you should expect to see rates start to creep back up pretty soon in the next couple of months. Now, let's see. Quick note on fair market value. What you want to offer, the amount you want to offer, is a very personal decision. And your agent usually won't suggest a specific price, but they'll help you interpret the market data, identify a range, and weigh the risks and benefits of offering at different prices. So the definition here, the amount a willing buyer would pay and a willing seller will sell for, with no party under any particular obligation, necessity, or duress. This is the legal definition, and we see that fair market value is largely based on perceptions, just like the stock market. The more people think something is worth, the more it's actually worth. So when you're looking at fair market value from a buyer's perspective, you don't want to only look at the sold comps, comparable properties. You don't want to only look at the sold properties because those are gone. They're not available anymore. You also want to look at what your alternatives are. Where is the market going? What is your urgency of your need or desire to move? Where are mortgage rates going? How much is it going to cost you if you wait? If you find the perfect house right now and maybe you're not coming to an agreement with the seller on fair market value, but if you wait and you get it for a lower price, but then the rates are higher, it might just equal out. So there's a number of factors that you want to look at. It's going to be entirely personal, although it should be based on market data to a large extent. But you'll have an agent hopefully helping you to kind of navigate that. And it comes down to what you feel comfortable with. We are still in a seller's market. It's almost always a seller's market in San Diego and across California because the demand exceeds the supply. Everyone wants to live in California. And so the sellers have a little bit more of an advantage in terms of negotiating the terms of the contract, but the market has been slowing to a more steady pace of growth. So as buyers, instead of paying 100% of list price like we were seeing in 2013, last year we saw that go down. And right now buyers are paying on average in San Diego about 95% of the listing price when they buy a home. Oh yeah, so I like my little fire, my little fire animation, but anyway, I just had to put that in there. So our principles for negotiation here. Of course, we want to be very specific in identifying our goals. We want to write them down. It's easy to get overwhelmed by information overload once you start looking for a home. So just be clear about what you want to achieve in the beginning and have that written down to refer back to. Of course, emotions will factor into which home you choose, but when it comes time to negotiate the terms of the deal, you want to treat it like a business transaction. In that vein, you want to consider your best alternative to a negotiated agreement, which is essentially about evaluating your alternatives. It is essential to make an informed decision, obviously. Your agent, as her role in her role as a fiduciary, can help you make sure your assessment of your options is realistic, because as some have cautioned, they changed the acronym to estimated alternative to a negotiated agreement because sometimes we have unrealistic expectations about what our true alternatives are. So you're going to want to consider, like I mentioned, the possibility of rates going up, your need to move, how soon you need to move, what your other alternatives are. And if you have a good agent with you, hopefully they can help you determine if that's realistic. So we want to definitely be prepared. We're going to know what the other party is trying to know what the other party is thinking and where their interests lie. And I'll be sharing some tips that what I would do if I was advising the seller. So if you run into some of these situations where the seller is playing hardball with some of these contract terms, you'll be anticipating it and you'll be able to deal with it. And don't forget that the definition of fair market value is what the parties will agree to. So the end goal is always to make everyone happy and to come to an agreement. So just keep that in mind. It's a win-win. All right, we're going to get into the sale process here. These first couple of bullet points are your Law School Contracts 101. Offer plus acceptance equals legally binding sales contract. Now, in reality, offer plus acceptance doesn't happen that often. Normally, we'll have a couple counter offers back and forth. So, for instance, if you make an offer by the standard terms of the purchase contract in California, the offer will be good for 3 days. If the seller is going to accept the offer as written and not try to counter offer or change anything, they'll have 3 days to accept that, or the offer expires. Now, if the seller does a counter offer, it actually extinguishes the original offer and acceptance period and puts that offer and acceptance power back in the buyer's hands. So the seller can actually do a counter offer at any time. They can do a counter offer to you after your original offer to them had expired because it creates a new offer and acceptance period. Now, once someone accepts an offer or a counter offer, either party, within the acceptance period in the contract, you have a legally binding contract. Now, there are a lot of quote unquote, what I like to call trap doors in the contract, a lot of reasons that the buyer can pull the plug on the deal while in escrow, but it doesn't change the fact that you do have a legally binding contract. You just have certain specific reasons why the buyer can, pull this trap door and pull the bottom out from under the contract. So under the next point here, under California law, all contracts have an implied covenant of good faith and fair dealing. So both offer and acceptance must be in good faith, which means a true intent to complete the purchase on the terms stated in the contract. Now, if you cancel based on an invalid reason, you could lose your earnest money deposit as a buyer. We're going to talk about that more in a second. Okay, now, by the standard contract terms, and I know that I keep saying that, all sales are as is. Now, what I mean by the standard contract terms is there's a standard form contract used in California across the state. It was created by the California Association of Realtors. It's called the Residential Purchase Agreement and Joint Escrow Instructions. We shorten it to Residential Purchase Agreement, or RPA. But it's a standard contract that was created by the attorneys at the California Association of Realtors. It's based on years and years of experience of hundreds of thousands of buyers and sellers. And I'm going to give you a little glimpse at it here. This is just the first 2 pages of the purchase contract. And you'll see that it's just incredibly detailed. It's 10 pages long, 31 paragraphs, and some of those paragraphs have up to 12 subparagraphs. It's the backbone of the transaction. It is, when I say it's the purchase agreement and joint escrow instructions, it sets out all the timelines and the responsibilities for third-party costs, such as who's going to pay escrow fees, title fees, inspection fees, environmental reports, and what timelines all the parties agree to abide by, including the escrow and title people. So the escrow people actually become sort of bound by this contract as well, and they do end up signing it as well. So I know it seems excessive, but every provision is actually in there to protect you. Every provision is in there because somebody has run into a problem with this at some point in the past because it wasn't clear or wasn't defined. So it's in the contract now. So you have this backbone of the transaction, this 10-page document, this contract, and then you have hundreds of other addendums and forms that become incorporated into this contract depending on the specifics of the transaction. So you really want to make sure that you have someone who really knows their stuff in representing you, because knowing how to use these standard forms is very, very important. Also, this is a really great timing for this webinar because this residential purchase agreement was recently in November of last year, as in about 3 months ago, completely overhauled. It has been changed drastically. And I've had a lot of agents who are friends of mine, and they don't do real estate full time. They're part-time agents and things, and they're calling me up and they're asking me, "Oh my gosh, what is going on with the purchase agreement, the RPA? This is completely different from anything I, am used to." And yes, it's true. That's why the good agents, the full-time agents, there have been all these courses we've taken to learn about all the different changes into the RPA and how it affects our different buyer and seller clients. So anyway, this is really, really good timing for you on the webinar because I'm going to give you all these different little tips and tools that tell you what are the changes that have been made and what questions to ask when you're hiring an agent and what the correct answers are. So you know that they're really on top of their stuff and they take their business seriously. All right, so we're going on to the escrow process. Once you have an accepted offer, the buyer will put his or her earnest money deposit into escrow within 3 business days. Now, this money is now at risk if the buyer cancels the contract without a valid reason. And if I was representing the seller, just so you can anticipate, what to do in certain situations, I might ask the buyer to deposit more than 1%. You can legally ask the buyer to deposit up to 3% of the purchase price into escrow as their earnest money deposit. And that money is now at risk. So if you have a buyer client you have a buyer who's putting 3% into escrow, you can kind of be sure that person is serious about purchasing this property. So from a seller's perspective, that would be something that I would recommend. So when you're a buyer, if your seller asks you to do that during your initial contract negotiations, you can know that, it's okay. It's okay to do it, but you definitely want to be sure that you're 100% committed to following through on this property as long as everything is as you suspect it to be. Of course, you're going to have your reasons why you can cancel the contract and get your money out, but it's kind of a pain to get your money out. The seller has to sign something releasing the money from escrow, and they have a good faith duty to do that. But anyway, your money is out of your control at that point, and you have to fight to get it back a little bit. So now your buyer investigations commence as soon as you have an accepted offer. And as a buyer, you generally only have 17 days after contract acceptance to do all of your due diligence. The recent changes to the RPA they now give buyers 21 days to get final loan approval rather than 17 days, which is good because loan approval realistically takes more than 17 days. And in fact, it probably takes more than 21 days. And in practice, the seller will usually give you an extension of that contingency, which I'll get to and explain in a second. But the seller will usually give you an extension if you need longer to get your final loan approval, as long as you're showing that you're moving forward with your with committing yourself on the contract, removing some of your other contingencies, and maybe if the loan approval is the only one left, they'll give you an extension on that. Okay, now this is so important, and I'm convinced that almost no one understands how this really works. Okay. The federal law has an act called the Foreign Investment in Real Property Tax Act. It's pretty crazy. It requires the buyer to withhold 10% of the purchase price. And under California law, they have a mirroring provision in the tax code. Under California law, it's 3% of the purchase price to cover the seller's taxes if the seller is not, basically, if the seller doesn't meet certain circumstances. So under federal law, if the seller is a foreign person, the buyer needs to withhold 10% of that purchase price and send it to the IRS to make sure that the seller is going to pay any tax on any income gained from the sale of the property. Under California law, it doesn't even only apply to foreign people. It applies to anyone in California unless they meet certain requirements. So if the buyer, for some reason, fails to withhold this money during the purchase process, 10% under the federal law and 3% under California law, they can be liable to the IRS and the Franchise Tax Board for this money if the seller later doesn't pay their their income tax from the sale of the property. It's really insane to put this burden on the buyer, but it is what it is. There are certain safe havens that if buyers follow, they will be protected from owing this money to the IRS or to the Franchise Tax Board. But the safe havens are different under federal and California law. A lot of people a lot of the agents, they kind of understand how it works under federal law. I don't see a lot of people who understand how it works under California law. In fact, when I'm representing buyers, I often find myself in these conversations with Escrow where I'm asking Escrow for the documents I need for my buyer to fall into the safe haven, and Escrow either refuses to do it because they don't want to take the liability, or they just don't understand because there's a carve out where Escrow can act as a qualified intermediary. Oh yeah, under federal law, in addition, in order for the buyer to qualify for the safe haven, the seller has to provide the buyer with their social security number and a statement saying that they're not a foreign person. So, of course, no one wants to give their social security number out anymore because, identity theft is common nowadays. So there's a procedure where Escrow can act as a qualified intermediary. So the seller gives their social security number to Escrow, and then Escrow gives a statement to the buyer saying that they have this information on file, and then that satisfies the buyer's requirements. But often now escrow companies don't want to take the liability of being the qualified intermediary. So, it's just incredibly detailed, and you really want to make sure that whoever is representing you as a buyer knows how to protect you. Otherwise, this is a large amount of money, 10% on a purchase price. So that's $50,000 on a $500,000 purchase. So let's make sure that your agent really knows what they're doing on this. Sorry, that took a little long time to explain. So the seller has 7 days after acceptance to provide the buyer with all legally and contractually required disclosures and reports, and to disclose, in addition, any material fact that could affect the value and desirability of the property. So there's this general duty of disclosure on top of all the specific things that are required under California law and under the contract. And again, all disclosures must be made in good faith, which is honesty and fact. Again, you have that implied covenant of good faith and fair dealing in every contract in California. And as the buyer and the seller, just be prepared for a lot of paperwork. There's an average of 86 different forms, many of which are multiple pages. Basically, hundreds of pages of information is going to be exchanged and reviewed and signed by buyers and sellers in a typical home sale. All right, so as a buyer, these are your contingencies, what they call them. These are your valid reasons to cancel the contract. So, of course, you have your physical investigation into the condition of the property. You're going to hire a professional home inspector, and they're going to go through and just turn on everything. They're going to test all the appliances. They're going to test your water pressure. They're going to inspect the walls and the windows and, look for moisture. They have a moisture meter. They do a thorough investigation of the condition of the property. And sometimes they're going to recommend a secondary inspection. If they see an issue with the roof, for instance, you're going to want to hire a roofer or some other specialist. Maybe there's a little issue with the fireplace. Maybe appears to be a little crack. You're going to want to bring in a fireplace guy. So if you don't have a lot of time as a buyer, you only have 17 days to schedule, perform, and review all of these inspections, schedule and review any secondary inspections, and if you get into a position where you're thinking, look, I got to cancel the contract, or I have to work something out with the seller to reduce the price or have the seller do some repairs, you have to have those negotiations and come to a written agreement with the seller about those repairs all within your 17 days. So it's really not a lot of time in practice. As soon as we have an accepted offer, I'm helping my buyers get that physical investigation scheduled, the professional home inspector. So no time to waste on that. You have your preliminary title review. The title company will send you, their preliminary title insurance policy. You want to make sure that nothing looks strange, but really, as long as the title company doesn't see any red flags, you should be good on the title contingency. But if you find something weird there, you can cancel the contract based on the title review as well. Then you have your legally and contractually required disclosures from the seller. You can cancel the contract based on anything you find out here from the seller. And there's also a natural hazard disclosure, which is required by law. It basically tells you what are the environmental hazards outside the home, if you're in a fire zone or if you're in a flood zone or you're in a high wind zone. I mean, there's going to be a million things that the house is subject to. There's pretty much no way to get around it. But you just want to make sure that you understand that stuff and that you accept the property in the condition that it is truly in and in the environment that it's truly in. So you can cancel the contract based on those. And HOA documents, if you're buying in an HOA situation, this is hugely, hugely important. This is probably the number one thing that you're going to be looking at, because the HOA has so much power over your ownership of a property. And these documents can be very, like 500 to 800 pages. It's crazy because you're getting all these legal documents about the formation of the HOA and the HOA's rights over you. I mean, and the HOAs could even foreclose on your property and take it away from you for failure to pay their HOA fees. So that's a very important investigation. You want to make sure that you feel good about that before you remove that contingency, because by removing these contingencies, you're committing yourself further on the contract. You're saying, I understand what the HOA's power is over me, and I release my right to cancel the contract on that basis. So you've got a couple more. You've got the appraisal contingency. When you get a loan, the loan company will get an appraisal to make sure that they're lending the correct amount of money. They don't want to lend too much if the property value is not going to support the loan amount. So they'll order an appraisal, and the appraisal will come in, and it usually comes in about the right price. It comes in at the price that the parties have agreed on. But if it comes in low, you have the right to cancel the contract, or you have the right, because your loan won't be approved in the full amount if the appraisal comes in low. So if your loan comes in and gets approved at a lower amount and you actually do have the money to make up the difference, you can go ahead and continue to purchase the property and just basically pay that difference. Or if you need to, you can cancel the contract. Or you can try to renegotiate at that point with the seller. Just keep in mind the seller has no obligation to change the terms of the contract. Same thing with repairs. The seller has no obligation to agree to repairs, because that is a change to the terms of the contract. The contract is already set. It's already a legally binding contract. But in practice, once you get that far in, sellers will usually be a little bit flexible on that. And they'll say, okay, like, we've already gotten 2 weeks into escrow. I don't want to deal with putting my house back on the market and starting all over. So sometimes they'll be a little bit flexible and agree to a change in the price when these things come up. Of course, you have your loan approval. That's a very, very important one. And one of the changes that happened recently, I'm going to get into this in a few slides, but one of the changes to the RPA was, before in the RPA, there was just a little checkbox that you can check that says loan approval, loan contingency to remain in effect until the loan has funded. Well, they took that away. So you can still try to negotiate that term in the contract, but you're not going to be able to slip it by the seller as easily as you could before by checking a little box and hoping they don't notice. Now you actually have to write those contract terms in, and it's going to be more obvious. So anyway, in practice, most of the time, you just, go with the seller, go with whatever they want. If they want you to do a 21-day loan approval contingency, you're going to do that. And you're just going to, have a conversation in advance and hope that if you need a little bit more time, that they're going to give you an extension. And then, of course, you have one more contingency, which is for the sale of your current home. And that's a really important one if you're planning on buying one home and selling one home and buying another. So this is the contingency removal form. Putting this on here to demonstrate that the buyer has most of the control in the transaction. The buyer has a long list of contingencies that are reasons why they can cancel the contract. And they can even write in other contingencies. For instance, if it's an income property and there's a tenant living there, you would write in a contingency that says, we want to confirm the terms of the tenant's lease, how much money of security deposit you have of theirs, and the tenant will have to submit an affidavit stating that that is the rental amount that they're paying every month, how much their security deposit is, and all that. So we'll move it on here. So just to demonstrate, as a buyer, you have a lot of control over the contract because the seller basically doesn't have any reasons to cancel the contract. The only really reason that they have to cancel the contract is if the contingency for a purchase of a new home is not satisfied. The rest of the reasons that the seller can cancel a contract are largely based on the buyer's failure to follow through and perform on the deal in some way. So as a buyer, the name of the game for you is following through, doing your due diligence as quickly as possible, and removing those contingencies within the deadlines that are set on the contract, whether it's 17 days, 21 days, or whatever else you can negotiate during the initial contract negotiations. But you want to make sure you don't give the seller a reason to cancel the contract as long as you still want to purchase that house. Okay, so you get through all your contingencies, you negotiate any, repair items or anything else you want to change about the contract, and you remove your contingencies. You're ready to go forward. You deposit the rest of your down payment and closing costs with escrow, complete all your loan paperwork, which is another huge pile of paperwork, by the way. The seller completes any agreed upon repairs. Within 5 days before closing escrow, you're going to want to do your final walkthrough. And now, that's just to keep in mind, that's not a reason to find. It's not a time to find anything new that's wrong with the property. You have to do all of that within your 17-day contingency period. But this is just the time to make sure that, the seller has performed any repairs that they agreed to, that the property is in the same condition as it was when you first wrote the contract. So all the appliances are still there. Basically, everything else looks as it's supposed to be. The loan funds and the deed is generally recorded in the public records the next day. As soon as the deed is recorded in the public records, you own your home. You officially own your new home, and escrow is closed. It usually takes about a day in between because all the money from loans goes through the banks on the East Coast. So if you don't get the money, and they close at 3 p.m., so it's noon here on the West Coast. If for some reason they don't get it in before noon here, you can have a delay. So generally just anticipate that your loan funds one day and the deed records and you close escrow the next day. And seller will deliver the property generally by 6 p.m. on the day that the deed is recorded. And they deliver all keys, garage door openers, and they'll deliver it in broom clean condition. So make sure that you factor in a little bit of time to get the property, to get it cleaned up. You're probably going to want to hire a professional cleaner or, bring some of your friends in with pizza and beer and get them in there and scrub the place, because the seller is probably not going to, anytime you move, you know how it is. It's so hectic moving anyway. You're probably not going to, make the place spotless before you turn it over. So just build that into your timeline. If you have to give notice on an apartment or something like that, you want to have a couple of extra days of padding. And also, just in case anything happens with the closing of escrow, if escrow closes a couple days late, you don't want to be homeless for a couple days. So definitely give yourself, I would say probably about at least 5 days of padding time in between. And by the way, if for some reason escrow doesn't close on time, keep in mind that does not cancel the contract. The contract is still in effect, even if the term about closing escrow on a certain date is not met. So if for some reason something happens, everything gets put on hold, but you really, really love the house, just keep in mind that you haven't lost the house altogether. Maybe you've hit a little roadblock, but you're going to get through it if you want to, and you can probably still make your dream home happen. Okay, so just to demonstrate, there are a ton of people involved with closing escrow. Everybody's got to be working together. And, it's just another reason you want to have an amazing agent working for you to make sure that everybody else is on task. We're not going to have any unwanted surprises 3 days before closing escrow or 5 days before closing escrow. And, people are busy. People are human. They make mistakes. But that's why you have somebody, especially as you get closer to closing escrow, checking in, knowing what the different timelines are for the different people involved, and checking in with them and making sure they're on time. Also, your agent will be reviewing all the different costs that you're responsible for, making sure you're not going to get overcharged during escrow, because the final statement of all the different costs and things and allocation of costs, it can be a little complicated. So you definitely want somebody there to help you who understands what are you liable for and making sure you're not overpaying. Also, the buyer's agents in making sure the inspectors, the appraisers, the loan officers, everybody's performing within your contingency deadlines, which is a little bit before you close escrow. And that's to make sure that you don't lose the deal for failure to perform under these strict timelines. All right, so we're going to get into some buyer strategies here. So get your loan pre-approval in place and be ready to jump on a great opportunity. Just know that in this market, sellers always require your proof of your pre-approval and proof of your funds for down payment and closing costs with the offer. So when you write an offer, you give them all that stuff up front. They usually will not consider an offer unless you have your financing in place and can prove that you have the money for your down payment and closing costs. So get that all in place, start looking at properties, and when you find one that really hits all the marks, get it under contract right away. Get it under contract before anyone else can get in and swoop it out from under you. One of the ways to do that is to write an offer that expires in 24 hours. Now, keep in mind that the seller can always counter offer after 24 hours, but if you make a really good offer and you give it a 24-hour window, usually you can get the property into escrow before the other buyers. It's not uncommon to have, other buyers coming and looking at it, scheduled to see it in a few days. You don't want to let that turn into a bidding war. If you can get it under contract right away, that's definitely what you want to do. Okay, so you're always going to want to base your position on market data. You're going to have a reasonable and defendable basis for the price and the other contract terms you offer. And this helps you, first of all, by showing your hand a little bit, you get the seller to show their hand. So you can see what comps they're looking at. What are they basing their number on? And then you can have a discussion that's reasonable about price and hopefully avoid evoking an emotional response from the seller. So it leads to a better outcome in the end. Once again, you want to keep your primary goals in mind, such as getting into a house with X features with a certain monthly payment. If you can get that, don't get overwhelmed. Don't get eBay syndrome when you start looking at all your different options. Sometimes you get distracted from your goals. eBay syndrome, I don't know if anyone ever shops on eBay here, but it's great. It's a total rush, but it's easy to get caught up in that energy and being focused on wanting to win the auction and losing sight of that fine line where a good deal turns into not so good of a deal. So for instance, you start looking at homes that look like a better deal because they're fixer-uppers or this or that. When your lifestyle realistically demands that you find a place that's pretty much move-in ready, keep in mind that there are costs to that. The time and the effort and energy and the money it's going to take to get the place fixed up to what you want it to be, and the stress if your lifestyle, really doesn't accommodate that. Just keep focused on your original goals. Now, this one is really important, and don't underestimate the value of this. This is making a connection with the seller in order to get your offer accepted over other offers. It works. If the sellers are going to be home and you have a family and you're going to go tour the property, bring your family with you. Send them a personalized cover letter. I have had buyer clients who, had made a connection with the seller when they're touring a property. They wrote a really nice cover letter and sort of pointed out some of the similarities between the two and how they're going to take great care of the home and all these things. And I've been told that the seller, accepted their offer over others that were actually even higher priced offers because they just really felt a connection with these buyers. So I know it sounds a little hokey, but it works. So let's see. The last one here is just don't get stuck on price. Have an open mind. Maybe the list price is a good price. Don't walk away from the list price just on principle. It may be a good price, it may be not, but let's once again go back to that market data, look at your alternatives, look at what your other needs are. What's the cost of borrowing right now versus the cost of borrowing in 2 months, all these different things and that work together to determine whether this is a good deal for you and you feel good about it. Would you feel good about walking away over $2,000 or would you be kicking yourself? Okay, and here's an extra one. If you have trouble finding something that really works because we are in a low inventory market, depending on what your criteria are, there may be not a whole lot that's available to you. So one of the things you can do is if you have an agent who's willing to get a little creative, they can do a search in the tax database and they can actually reach out to some people whose homes are not necessarily on the market yet and see if they can find you a home. They can look at statistically, people move every 10 years. So you can look at people who have owned their homes for about 10 years. Maybe they're getting ready to move. Or let's say if it's non-owner occupied and the person's, collecting income from it, you run out of depreciation credits after 26 years. So maybe if they've owned the property for forever, they're not getting any depreciation credits. Maybe it's a good time for them to do a 1031 exchange and get a different income property and get those tax benefits up and running again. So there's ways to get creative. Now for buying and selling, if you're going to sell your home, I'm going to just get all these up here right now. If you're going to sell your home and buy a new home, it's a little the timing can be a little tricky, but you want to have the transactions occur almost simultaneously. So in this market, it's best to start looking early because of the low inventory, but you want to have your home pretty much ready to go on the market as soon as you find that your dream home, because you want to be able to write an offer on your dream home with an added contingency that you're not fully committed on that contract until the sale of your old home closes escrow and you have that extra money in your pocket so that you have that money for your down payment, your closing costs and things. Now this assumes that you need the money from your sale of your old home in order to purchase the new home. If you have enough money and you don't need the sale money to purchase a new home, you can forget about that. You can make a stronger offer on your dream home and you can just, sort of handle it as the timeline works best for you. But if you are like most people, you probably need to sell the old home before you get the dream home. So start, preparing your home for sale. Get some portable storage pods, start moving your stuff out, start making your home look like a model home, depersonalize it, make it so the buyer just feels like they can move right in and you should be good to go. You can, and the reason that you have it be ready like that is because when you make the offer contingent on the sale of your old home, the seller is more likely to accept your offer if they see that your home is already on the market. So you want to at least have your home put into the MLS that day that you make the offer on the new home, or preferably you had just put it on the market and maybe you even have already an accepted offer and it's going into escrow. That's going to make the seller of your new home more likely to accept your offer. And then, of course, don't forget about the Prop 60, 90, and 110 benefits you can get for property tax relief if you are 55 and older or if you're disabled. These are one-time special programs where the state of California allows you to take your property tax payment from your old home and transfer it to your new home. So if you're looking for a home that better suits your needs as you get into, basically your forever home, as you retire and you're going to be settling into older age, you want maybe a one-story home or you want something that's a little bit smaller and easier to maintain, you can take your property tax payment if you have a super low property tax payment and you can bring it to your next home. Okay, real quickly, a couple buyer traps to avoid, and I just added these in because they're good ones, but I know that we're running low on time. So one of the things I would recommend my sellers do is to require that buyers get pre-approved by a lender that they trust. So if you find yourself on the other side of this table as a buyer and the seller says, okay, I'll accept your offer, but you have to get pre-approved by my preferred lender just so I know that you're actually qualified on those terms. That's fine. You can do that. It's a pain. You're going to have to, jump through the hoops and get pre-qualified again, which is a pain. But you want to make sure that the the lender that the seller is sending you to is not going to reveal your entire hand to the seller. So for instance, if you're making an offer of 450,000, but let's say you're actually qualified up to 500, you don't want the seller to know that, because then obviously they're going to come back and say, no, you're qualified up to 500. Like, I want more money. So anyway, all loan officers have a duty to protect your financial information. But just in case, you want to write them a letter and put something in writing that says, you do not have my permission to share any of my financial information with the seller other than the fact that I am approved on the terms of the offer that I'm giving you. This is more and more common nowadays, so just keep in mind that this is how you want to protect yourself if you find yourself in that situation. And now you want to watch out for terms in the contract that the seller negotiates in that make your contingencies remove themselves passively. The way that the standard terms of the contract work, the contingencies, if you don't physically remove your contingencies, they still stay in place. But the seller has a right to send you a notice to perform, or they can cancel the contract if you don't remove your contingencies in a timely manner. But some sellers in this market, because they have a little bit of an upper hand in the negotiations, will write a term into the contract that says, after 17 days, your contingencies are automatically removed. So you're automatically committed on the contract, whether you're ready to be committed or not. So look, if they want to do that, okay. You can accept that. It's not a deal breaker, but it just means that you need to be a lot more on top of these timelines. And if you find yourself coming up on the timeline within, 3 to 5 days of one of these contingency dates, and you need more time, you got to get that written extension, or you have to cancel the contract. And you're going to have that written cancellation of escrow ready to go in case you have a problem communicating with the seller and you can't get that written extension, because there's no way that you're going to commit yourself on the contract and lose your earnest money deposit if you're not ready to make that commitment. Okay, so number 3, know what the different associated costs are customary for buyer and seller to pay. Make sure you understand all these little extra costs that you're agreeing to. One of the situations where this can come up is sometimes, the two parties are arguing about, they're negotiating about who's going to choose what escrow company we use and who's going to choose what title company we use. Okay, well, maybe you choose escrow and I choose title. Well, what happens when you do that is there's all these extra fees that get added on because these two escrow companies and title companies they charge extra for having to work together because they don't normally work together. There's like another, $450 in little miscellaneous fees. Some people call them junk fees that end up getting added onto the transaction. So, you may be better off actually going with a company that has escrow and title all in one company, and you're going to avoid some of those junk fees. And let's see, there was another one that I wanted to tell you about on that. So we're going to move on. I'll put it in an email. Now the seller, there's some changes under the law that says the seller now must pay for the HOA documents. There's no more ability to negotiate about that. So therefore, the funds for the HOA documents should not be paid through escrow because that's your money. So this is a new change that actually just took effect this year in 2015. And you want to make sure that the seller is going to follow through and they're going to pay their obligation, because otherwise it's coming out of your money. If for some reason you have to cancel the deal, then you have to go back and sue the seller for $400, $500 for the HOA documents. It's just silly, but it's coming up, and escrow companies are asking buyers to pay out of escrow for those HOA documents, which by law need to be paid by the seller. Bottom line, there's always something. Hire somebody who really knows their stuff. They're a full-time agent, a professional, not somebody who does it on the side, because the laws are always changing and you just want to make sure that you're protected. It's just too important of a transaction to try to take shortcuts. So we have some legal updates here for 2015. And like I mentioned, the seller cannot pass on those the fees for the HOA documents to the buyer anymore. Also, there are new procedures that make it easier for the buyer to get their earnest money deposit back from escrow if they have to cancel the deal. So it's great for you. Buyers now get 21 days, as I mentioned, for their loan approval instead of 17. If you end up in a situation where you're looking at a foreclosure or another REO, which means bank-owned property. A lot of times they'll send you to these auction sites. And now there's laws prohibiting these auction sites from making what they call shill bids, basically just fake bids that are just made for the purpose of driving the price up. They're not made by real purchasers who actually want to purchase a property. They have now disallowed prepayment penalties on FHA insured loans. And when you're buying an REO, which is again a bank-owned property, the bank can no longer dictate which escrow and title company you use. So these are just all sort of like random little things. Okay, this is the lender that I wanted to tell you about. She is just really amazing. She's really great at listening and formulating loan options that are really specific to your particular situation. So I definitely encourage you to talk to her, see what your different loan options would be that you qualify for, and she'll make something that's specifically tailored to you. And as I mentioned, per the Federal Reserve minutes that just came out in January, we're anticipating interest rates will start to go up as soon as April. Okay, well, rules for hiring an agent. Of course, I'm biased, I know that, but this is the attorney in me talking now, and that is, you know what, the transaction is too complicated for you to put that burden on yourself to try to like learn it yourself. I understand, we all want to be smart about money. We all want to save money. But when it comes down to thinking about hiring a buyer's agent, first of all, it doesn't cost you anything because normally your buyer's agent gets paid by the listing agent at the close of escrow. So if it's not going to cost you anything, you really should think about making sure you're just hiring someone who's really, really good. And that way they're going to protect your best interests. Buying a home is a full-time job, even with an agent. There's a ton of stuff you're going to be reading and thinking about and analyzing. So, don't put that unreasonable burden on yourself to try to also represent yourself and learn about all these other things that go along with, with the purchase contract. It's simply not going to happen. You can't learn in one transaction all the different things you can think about 3 steps ahead. Now, some buyers think that they can save a little bit of money by working with the listing agent, but just keep in mind that this listing agent has a fiduciary duty to the seller to get them the most money and sell the house in the shortest possible time. This, by definition, conflicts with your fiduciary duties as a buyer's agent. So, ask yourself, if you run into something in the contract where, it's really in your best interest to cancel, do you think that that agent is actually going to recommend that you cancel and give up their double commission and violate their fiduciary duty to the seller? Or, there's definitely a conflict of interest there. And keep in mind that when the listing agent agrees to represent you, a lot of the time they'll throw in maybe 1%. They'll reduce their commission. The thing is, they're not going to let you represent yourself if you don't know what you're doing. They know that they're going to have to do the legwork and they're going to have to provide the forms and, guide you along and get you across the finish line. So they're going to want to represent you and get paid for it. But they'll throw in, reduce their commission, throw in 1% or something into the pot to give you a discount. But in reality, you could have probably negotiated that 1% off the purchase price anyway, or more, if you have a good agent representing you. So my advice, the attorney in me, the experienced real estate broker in me says, find yourself a really good real estate broker who knows what they're doing. They're going to be able to negotiate that money off the purchase price for you anyway, and they're going to really be able to protect your best interests, which is the most important thing. Okay, interview questions to ask your agent. So, in your opinion, what are the most important changes to the new RPA and why? Clearly, the backbone of the transaction, you want to make sure your agent knows what has changed, what are the most important things to buyers. And as we've kind of gone over some of those things about not having to pay for HOA documents anymore, getting 21 days for loan approval. Now, another one that it actually goes to the second question here, what's your stance on the wood destroying pest addendum? That's a little bit of a trick question because the wood destroying pest addendum used to be used in conjunction with every offer. It was an added addendum that would be submitted with every offer. Well, now it has been eliminated and incorporated into the new residential purchase agreement. So in the past, the industry practice was that there would be this wood destroying pest addendum submitted with your offer, and it would say The seller agrees to pay for any termite damage that's discovered during escrow by the termite inspector. And the buyer agrees to pay for anything that could lead to termite damage in the future. So there was this allocation of costs before you even know what the damage is. So as a buyer, that was great. That was favorable to you. If any termite damage is discovered during escrow, the seller's already agreed to pay for it, no matter what it costs. So yes, it's important. It's a standard part of the offer, but whether I recommend that you use it with the offer, it will depend on the circumstances. If you want to make your offer really competitive and there's not that high of a risk of the termites, for instance, if it's in an HOA situation where the termites are usually on the external part of the building and the HOA will cover that rather than it being the responsibility of the homeowner, maybe I would tell my buyer to leave those terms out of the contract in order to make the offer stronger. So whether or not they would recommend you use it, that's going to be a judgment call based on the particular situation. But these two questions work together in that you want your agent to know that the wood destroying pest addendum doesn't even exist anymore and it's incorporated into the RPA. Okay, will you accompany me on physical inspections? Yes, you want your agent to be there as a second set of eyes. You have to do your due diligence. You have to make sure you feel satisfied that your questions are answered, but your agent, it needs to be a full service agent and be there with you to be a second set of eyes and point out any red flags. Performance guarantees, a lot of agents do offer performance guarantees, and so do I. So I'm going to get into that in a minute, but you want to find out the terms of that. You want to find out how much their agent, how they get paid, how much they charge, and when and if you're going to be obligated to pay them. As I mentioned, normally the buyer's agents get paid by the listing agent upon the close of escrow, but under certain circumstances, they may not. So for instance, if you are interested in a property that's for sale by owner, it doesn't have that built-in payment to your agent because it's not through the MLS, it's not through the standard procedure. So make sure that your agent is upfront with you, because if you have a contract with your agent, it says in the contract that you're going to be obligated to pay them if they don't get paid by the listing agent somehow. So for instance, just with my clients, I'll have that conversation with them upfront and say, look, if you get in a situation where you really want to buy it for a sale by owner, I'm not going to, proceed unless we figure out if the for sale by owner is willing to pay me for my services, or if you're willing to pay me, and then we'll modify the offer price accordingly. Basically, you're not going to get a surprise bill at the end. I'm not going to go forward until you know what the different obligations are and the different consequences. Okay, these last two are just to make sure that your agent really knows the local market. They're definitely good to ask them about housing stats. By the way, the San Diego numbers are in the last 30 days, there was about 2,100 homes sold, 2,103. 415 were bought with cash. Average sale price in San Diego is $562,000, and average days on market is 49. And the average sale price to listing price ratio now is 95%. So you're getting a little bit more flexibility in negotiating that price down. And the water retrofit is another test to see, this is a San Diego specific thing. In the contract, there's a little box that you'll check that says who's responsible for any government retrofit requirements. In San Diego, this is what this means. The city of San Diego requires that when you sell your home, all of the plumbing fixtures are replaced with a low water flow fixtures. So low flow toilets, low flow shower heads, and low flow faucets. It's just another thing that people don't understand what it means. It can be an unpleasant surprise during escrow. So if the seller agrees, you ask the seller to agree to pay for any government retrofit, and their agent doesn't know what that means, and you discover partway through that they need to put in all new toilets and shower heads and faucets, and it's an extra $800. I mean, it's really silly to think about the deal falling apart over $800, but unfortunately, it happens when people don't get proper advice from their agents in advance. So this is just to test and make sure that your agent knows all the little local details. And if you're anywhere else in California, you can simply ask your agent what government retrofit requirements apply at the time of sale. Okay, yay! So here's a free gift bonus offer. There's going to be, like I said, a little real estate cheat sheet. It's a condensed version of this, and I'm also going to make this recording available. So don't worry if you missed a couple things. And then also, I have a bonus offer for anyone in San Diego who thinks that they might want to work together after hearing my spiel. So this is my premium buyer package. And I'm not, trying to put a number up there and saying, oh, this is worth this, this is worth this. Okay, these are real values. That actually the having MLS access is actually a little bit more than $600 a year. But it's really cool, the MLS access I can offer you. You get a personalized client portal where you can get the results. You can have as many different searches as you want. You can look at vacant land searches. You can look at 2 to 4 units. You can look at regular single family homes. And you have this personal website where it organizes all your results, and you can mark them as favorites or possibilities or rejects. And it's really cool. And then also I've created this buyer bootcamp program. It's an educational program. It's tailored to your specific situation and your timeline for buying. And so basically it's a more detailed version of what we've gone over today. Also, I have some interactive closing costs and investment worksheets so that you know exactly how much you're going to be spending, how much you're going to need for your closing costs. If you're looking at investment property, you can factor in all the different management costs, vacancy costs, all these different things to make sure that you're making a good investment if it's an income property. And then we're talking about performance guarantees. I do offer a $5,000 savings guarantee. So basically, if I can't negotiate at least $5,000 off the sale price for you, the listing price for you, then I'll give you a credit of $1,000 upon closing. And then the housewarming party, this is a special offer just for our webinar attendees. About 3 weeks or so after closing, I am offering a housewarming party completely taken care of, completely paid for, invitations, cleaning service, before and after, catered food, beer, wine, soda, all of that. It's a really good way. It's an incentive to get unpacked, and it's a great way to meet your new neighbors and just celebrate your fabulous new milestone in your life. So go to homeownersuccess.com/thank you. All lowercase, one word on thank you. And there you can claim your free gift, which is the real estate cheat sheet. And you can tell me if you would like to take advantage of this buyer package, or if you're somewhere else in California. I know a ton of good agents in other areas of the state, also other attorney brokers who I would feel real confident referring you to. So if you'd like a recommendation of somebody really amazing in your area, please, you can indicate that on there. I know people in the San Luis Obispo area, know great attorney broker in Orange County, LA area, and also in the Bay Area. And I also actually do some deals in the Bay Area occasionally. So either way, we'll make sure you're really taken care of. And that's it. So I just really appreciate you taking the time to attend this webinar. I hope that you got my information, but if you go to the homeownersuccess.com/thank you, I will get your information. I'll definitely make sure that I get in touch. So if you ever have any questions in the future, you can get a hold of me. Thank you so much, and have a great